My next problem with my lawyers is do not expect them to understand numbers. And I'm about to talk MI. I once worked with a big firm, 40 plus million turnover firm. They were so proud of the management information they produced. You know, the managing partner was delighted with it. The internal accountant was delighted with it. I asked a question. I said, how many of the management committee do you think read this? Oh, all of them, I was told. And they understand it. Oh, all of them. And I went, let me test that out, because I bet you two things happen. One, they don't read it, because they don't want their numbers blind. But actually, they do read. They read one thing, their team's report. And they benchmark to their mates to see, am I doing well, am I doing badly? And that's the limitation to which they will read your management information. I'm going to share with you my thoughts about management information and what I do with it, how I use it, and how I've understood how to use it and look at it. What do I expect when I'm working with accountants, with my lawyers? I expect intelligent opposition. If you ask a lawyer to do anything, they'll ask you why. Why should we do this, Steve? If you want to invest in anything, why are we doing this? Why? Why? Why shouldn't I do it? Right, give me a good reason not to do it. Because they never make decisions. The non-lawyers in the room, when you interact with lawyers, just understand, they are trained not to make a decision. They are trained to tell you what not to do. Don't do this. Don't buy that house, it's got subsidence. Don't invest in this business. Don't. They're trained not to do something. Because if they tell you to do something and they're wrong, you will sue them. That is their business model. Put a group of them together as a group of partners and try to get them to make a decision. Good luck. That's the problem you get when you're non-lawyers engaging with lawyers. You expect them, the accountants particularly, get hugely frustrated with them. Why won't you make a decision? The IT people, why won't they invest in something? Right, just get on with it. Try something. Make a mistake. Hurrah, you can't get sued for making a mistake. Or you can if you're a lawyer because you think, oh no, I got it wrong, I'll get sued. So they have a real challenge with them. They never make decisions. My next problem with my lawyers is do not expect them to understand numbers. And I'm about to talk MI. I once worked with a big firm, 40 plus million turnover firm. They were so proud of the management information they produced. You know, the managing partner was delighted with it. The internal accountant was delighted with it. I asked a question. I said, how many of the management committee do you think read this? Oh, all of them, I was told. And they understand it. Oh, all of them. And I went, let me test that out, because I bet you two things happen. One, they don't read it, because they don't want their numbers blind. But actually, they do read. They read one thing, their team's report. And they benchmark to their mates to see, am I doing well, am I doing badly? And that's the limitation to which they will read your management information. That's wrong, Steve. That's not what happens. So I took pleasure in sitting down in the meeting, and I went round the table asking each of them, do you read and understand it? Let's be honest, do you? No. Do you read your own team? Yes, I do. And everyone then admitted they didn't read it because it was brilliantly complicated and full of numbers. Right. So that's my challenge to you. As we look at this and looking at management information, what are you giving them and why are you giving it to them and why are you getting it? Next bit is I multiply the turnover by 10 of my professional service firms to compare them to a corporate. I was talking to someone at the coffee break, 2.5 million turnover. Immediately you think, oh, I'm quite small as a business. Because banks make this habit, they benchmark you by turnover. So they put a £2.5 million law firm with other £2.5 million businesses, which are all pretty small. But actually, if I said multiply you by 10, if I put you next to a 25 million turnover business, you think, well, they should have an FD, and they should have information, they should have management information, because they're 25 million. We're only 2.5. No, you're not. Multiply your turnover by 10 to get the complexity of what you are as a business. And we are complex because we're people businesses. We employ people to deliver services to people, paid for by other people in a regulated arena. That leads to complexity. Do not underestimate your complexity by the size of your turnover. So that's my benchmark to it. Right, lovely topic. Let's talk about management information. How do I use it? I'm going to share with you how I was taught to use it as the managing partner of my accountancy firm. And what I did and what I put together. And fascinatingly, so much of this resonates to what you've just been talking about and the previous speaker did. So we're on the same page, which is lucky. Right, running my law firm as a business, because you're a business, right? You know, the SRA have now got the Principle 8, you're running a business. A decade ago, I used to lecture with the Law Society, for the SRA even, at their very first conference when they brought Culp and Coffers together. And someone came up very offended going, you don't understand, we're a profession, we're not a business. To which I had to point out, no, actually, you're a business that will be a profession. But there you go. So what do we do? Common issues, just so we understand we buy and sell something. Right, we buy and sell hours. That's what we've all talked about. You're measuring hours. Right, we measure a product. It's really complicated for us because the hours walk in and out of our building. And we're trying to work out how good we are. The first speaker was talking about the challenge in succession, the snowflake generation. You know, they've melted as soon as they sit at their desk. Right, the next lot in, huge structural issues with succession. I used to talk about your profession calling you male, pale and stale. Right? Old white men are the principal owners of most law firms. I now call them male, pale and frail. 10 years later, they're 10 years older and they're still running their law firms, trying to make decisions or not. Back to the generic problem. How the hell can you run a business if you don't make a decision? But that's where we are. So how was I taught to do it? I was taught this. I was taught to measure 5 things. I was taught to measure work taken on, because that leads to the hours that I need to buy and sell. And the hours leads to my work in progress, and the work in progress leads to my bills, and the bills leads to my cash. And when I understand those 5 principles, I'm running my business. I'm running my business looking forwards, understanding what's likely to come my way, not running my business looking backwards. And then, so how do I get there? How do I do this? Well, I look at it box by box. Work taken on. New matter starts. Right? You've got it on your system. It records the number of new matters. You're recording your number of new matters. It's benchmarking for you. It's fantastic. Right? For me, I like to see a picture. I like to see trends. I like to understand what it's meaning for me. Right? You know, because actually it's really about the value, not the numbers. Because in corporate, they'll all go, Steve, you know, we could have 3 big matters a year in corporate finance. When you're in an accountancy arena, you know, they remember the one big job for the year and forget everything else they've done. Right? So the corporate guys are lovely, company uncommercial, as I call them. Right? All the issues that go with scope creep and all the other bits and pieces they do. But actually, and for me, you measure it. Right? Very importantly, because I now know my direction of travel. Why is it my direction of travel? Let's walk through this. My work taken on leads to my hours that I'm buying. Because that's what we do, right? And it's a real conversation. Again, the first speaker was talking about the problem you've got in actually getting good hours now. And it's a shame I haven't got the picture because I can show you, and one of my graphs is that the problem you've currently got is what you stopped doing as a profession in 2008 is you stopped training people. As did the accountants and other professions. If you remember, they were all sent on holiday for a year. Go and have a year off and come back next year. Right? Wait a minute, 10 years down the line, they've gone 3, 4 years, get their post-qualified experience, they now 5, 6 years experience, the engine room of your firm. Right? You could make those guys do 2,000 hours a year, and they said thank you at the end of it, because they were gaining the experience that made them then become a partner in training. That was the engine room of your practice, yet you stopped training them 10 years ago. What a surprise. You now have a real problem in actually filling your engine room full of staff. So hours, you buy your hours. Now there's a table. Hurrah, there's a table of numbers. So my accountants feel happy, my lawyers immediately switch off. Now, this is my way of doing it, and it is fascinating because it resonates for some. It's not the sort of... But what I do is, when I go into a firm, I understand the departments. I look at the hours we bought. How many budgeted hours have you got? What's your charge-out rate? That's what I've bought in the business. Then I look at how many hours you've delivered, and I can then compare and contrast that. You had colour coding. We hadn't prepared this beforehand. I go red, amber, green. Hurrah! Right? I'm getting a feel for the hours that I'm buying in my business. Because when I understand the hours I'm buying, I can look at the hours that I sell. I get a feel. That is just a one-shot snapshot. Right now with the Katchr system, it's doing it regularly. So I'm getting a feel. I'm buying hours. What hours am I buying? How am I selling them? What departments are going well? You know, what departments are doing badly? What departments are doing well? You know, and I can also see within that some classic issues for me about certain people. Let's understand, there's no right and wrong way of doing this. Because I've walked into firms where the partner hoards all the billings to themselves, so they look brilliant. Right? And then the team has no billings, and they look rubbish. And then in that partner's meeting, that partner says to the other partner, how I'm doing brilliant, you're rubbish. Because in that team, the partner's not done the billings, but they've got the billings allocated to their team. Who's best in that team? The one who's stolen all the bills or the one who shared it to his team? There's no right and wrong way. I think I prefer to share it than steal it all. But that's what you do. So I've got information. I'm trying to get a feel for what I'm doing. I can then look at my salaries. I can then compare what are my ratios. What have I bought? How much have I spent? What am I doing with it? This is giving me information that I can see at a glance. Then actually, I'm going to talk about this in a minute, lockup. I also then put my debtors, my WIP, my disbursements, watch them very carefully, on a table so I can see the lockup by individuals. Right, I'm getting my feel for lockup. Let's talk about that in a minute. So I know my work taken on. That's what my management information should be telling me. It leads to my hours that I bought. It leads to my work in progress. I now understand work in progress. Do I understand work in progress? Oh, I measure it, but do I understand it? Challenge. I did this in a PI firm many years ago, many years ago. I walked into a personal injury firm doing road traffic accident. And what we could do is we could look at the whole sector, we could look at all the cases they had, and we could see what their bell curve of work in progress looked like. How was the life cycle of an RTA case? And it goes through a bell curve and had a maturity of about 10 to 12 months. Some cases here with very little work in progress, some big cases with a bulge of work in progress, a few cases out here with a lot of WIP, cases here with little, and you go through a bell curve. Okay, and what happened in the RTA world? In the good old days, you could make £1,200 a case, cost you a couple £100 to get the case. Happy days. But then slowly the cost of buying cases increased. So what did they decide to do? Oh, we'll stop doing RTA cases. We're now going to do slip and trip, ELPL cases. We're going to earn £4,000 or £5,000 a case. Hurrah, Steve, let's go to this sort of work. What's the working capital cycle of an ELPL case? 18 to 24 months. Was in those days. It's now even longer. What happens when you decide to move from fast case RTAs to longer running ELPL cases? Surprise, surprise. When you get to about 12 months, this lot's run out and this lot hasn't started, and you run out of cash. Because you've moved into a type of activity you do not have the working capital to sustain. Do you understand working capital? Do you know what it means to do different types of work? And so I walked into firm after firm who'd run out of cash, who were going from here to here. And so they were all surprised when they ran out of cash, and I wasn't. The question was, what's the quality of that next level of work like? Is it good enough? Will it mature and develop? Fascinatingly now, my lawyers have decided this doesn't work for them anymore. So do you know where they've gone to? Hurrah, good news. Let's go to clean egg cases. Now, the scary bit of that picture is it doesn't stop. Right? Because basically 3 years is no longer a reasonable assessment for it. They're out to 5, 8+ years. Is the lockup, the work in progress you've got for doing one of these cases, and they're big. Can you afford to do that? No point saying, I've won a great job, we're going to get paid in 10 years' time. Hurrah! Good for cash. Do you understand the dynamic of work in progress by the type of activity that you're doing? It's not just measuring, it's looking forwards with it. So that's my next lesson. Oh, the other thing that came out with it, and I did this in another firm, I understood their bell curve, and I found this. I found a bulge at the back end. And I go, what's all that about? They shouldn't be there. And I said to the managing partner, I bet you what your fee earners are doing is they're getting cases that are settled, and they're now fighting for an extra lump for their clients. Good for them, hurrah, well done. But are they being pedantic on that last 500 quid? Have they asked the client, would you like to have £5,000 today or £10,000 or £6,000 in 12 months' time? Right? Have you positively asked that question? Because that's your responsibility. Right? And if the client says, I'll have my £5,000 now, you deal with it. And they said, oh, that's not happening, Steve. Can you go and check? They went and checked. They came back and said, that's happening, Steve. I went, okay. So now we've got some lockup, some unnecessary lockup in our working capital here that we can deal with compliantly, professionally, and deal with the issues that go, because you could see it, because you can understand the data and check it. And then I created this. Now, this is my grid of lockup, and it moves and it varies. Because lockup for me is departmental. You talk about benchmarking, and you go to benchmarking stats and all the issues that go with it. Be very careful when you benchmark, because no two firms look anything like each other. 2 5 million turnover firms, can you benchmark them? Well, no. Not if this one's conveyancing and this one's criminal and this one's another one which is Clineg and this one's RTA. They're all 5 million turnover. Absolutely none of them will look the same. So be careful when you benchmark. So my benchmarking is I look into the firm and I look at what's my, for example, residential conveyancing. I know my resi conveyancing lockup, the work in progress. You don't time record frequently because it's all Fixed price, Steve, so we don't need to record the time. Rubbish. You should record the time. We then work out whether or not you're actually efficient, and we're efficient in pricing it, different point. But I expect 2 or 3 months of lockup in that. It stretched in the last recession. Right, went out to 3 or 4 months because actually you saw a slowdown in the market. It's stretching now, out there. As the resi market is slowing down, that's stretching. What effect does that have on your working capital? Quick running conveyancing work is slowing down. It's still there, but it's slowing down, which is having an effect on cash. Do you understand the divisionalization of your organization? And I get a feel for each of my sectors, and it'll vary between inside your business. So there's no right or wrong way, but you need to understand what your lockup looks like. So if it stretches within your business, how are you dealing with that? All right, so back to so we understand work taken on, we're recording it, we know our hours, we're recording it. Oh, interestingly, do you, at Bretherton's, do you have 2 screens or single screen?
2.
2 screens, why?
People are more productive.
Absolutely bloody right. Right, 3, 4, 5% increase in chargeable time by having 2 screens. Because on the one screen, they constantly have their time recording system working. So you don't have to flip in and out. You think it's easy to flip in and out. It's not. Just move your mouse across, time recording's catching your time. Right, 2 screens, huge improvement. For 100 quid or whatever it'll cost to get that second screen on a fee earner's desk, massive improvement to them. Because you catch the hours. Right. My mantra is always, I love people to catch all their hours. I've never criticised anyone for a write-off. Write-off's my problem. I brought the wrong type of work in. I gave you the wrong type of work. I gave you the wrong systems. We've got a loss from that. How do I understand that so I can spin it back and improve it the next time? I've walked into firms where they beat up the staff for a write-offs. How dare you write off any of my time? Consequence of that is your staff steadily reduce the chargeable time to the point where they'll under-record their time because they don't want to be beaten up. We employ clever people. Their behaviours are driven by how we expect them to act. So for me, it was always charge all your time. My problem, how I recover it. So that leads to my work in progress, which I've done, which leads to my bills. And what I've got locked up in my work in progress and my bills is my lockup, right? Stock in any other context. It gets used for the non-accountants and sometimes my lawyers, and definitely the people on that side of it. They talk about lockup. Lockup's a bad thing. Well, excess lockup is a bad thing. But you inherently have to have lockup in the order to deliver what you do as professional service firms. So lockup is good because it's the stock that lets you run your business. It's bad if it's unnecessary or if it gets old and tired and dead. So you have to evaluate it regularly and freshly and keep on understanding what's going on. Because then that leads to my cash. Fascinating. We're now going to look at cash. When I started at Levy was my firm of accountants, I was practice manager. So my job was to set the systems up to measure this in paper, because we didn't have computers. It's a little while ago now. I had to produce the budget of the hours we bought. Interestingly, the very first time I did it, I got a very big piece of paper and pencil and wrote out all the staff and all the charge-out rates and multiplied it all up and generated my budget for the year. Very pleased with myself as a young man. Took it into my partner, said, there you go, I've done all this. He goes, that's great. He goes, what happens if you increase charge-out rates 10%? Well, I take it away, I rub out all this bit, I re-analyse it, I add it all back up and I bring it back to you. Right? That's genuinely what we had to do in those days, right? Because we didn't understand. But that's my job, was measuring the work, dealing with the hours, and then recording the WIP and everything else. Recession comes. I was working in a restructuring team. My senior partner looks at me and goes, we're off to see the bank. Why are we off to see the bank? We're off to see the bank, Steve, right? Because this is now growing. How long does it take to go from here to here in a restructuring arena? 6 months. Because we've got to buy the staff, get them on the desk, give them work to do, get in, be appointed, realise the assets, persuade the creditors we're really worth all these very modest fees, and then get the authorities to get paid. 6 months it takes us to go from work taken on to getting the cash in. And in the meantime, I've got to invest a huge amount of money in people. Sadly, they want to be paid in the month I employ them. Really bad news, that. I'd really love them to be paid when I get the cash. Nope. You've got to pay me now, Steve. All right, I've got to pay you now. So that was opening up a working capital hole to us, which my senior partner saw. I was new. I understood that after he explained it to me. We went to the bank. We go to the bank and we say, please, sir, can we have some more? Can we have a facility? And the bank manager looked at us and he sort of scratched his head and went, look, you didn't quite do it this, but it felt like this. Look, you don't understand what happens. What happens is you run out of cash, then you come and tell us why you've run out of cash and we'll lend you more cash. You don't explain to us in advance that you're going to need cash, which you then intend to repay to us. That's not how it works. And we went, yes, it is how it works, because it's how we work. We understood our working capital requirements and went and got the facilities before we needed them. Hurrah. Good news, we can grow. And that was about £1 million, so it wasn't like a small ask, because we had a lot of working capital to build up as we were going in the directions we were. More difficult bit came 3 years later. Now I am managing the practice, and I do understand what's going on, and I'm looking forwards. And I'm looking forwards, and this starts to drop. And I go, interesting, what does that mean for me? Is it us? Oh, back to the marketing bit, should we be out there, should we be finding more, or is it structural? That actually the economy is recovering, the amount of requirements of our services is declining. No matter, yes, we might do more market share, but to stay still, we've got to get actually unsustainable levels of market share. We aren't going to do that. So now I have a mess. Now what do? As staff leave, I don't replace them, which is good. But there's a real danger. If I now don't act, who will leave first? My best staff. They will see what's happening, they will see they're underemployed, they will see the future and will have gone. So what I had to do was, sadly, go around to the offices with my head of HR and me, and whenever we walked in the office, everyone went, oh no, they're here. Right? Because when we couldn't lose enough, we had to actively take actions to lose my hours I bought. Because by acting early, I actually had a controlling event around my practice. Interestingly, I'd then go to marketing events and other events, and people say, you must be in trouble, Steve. I heard you lost some staff. Oh, dear me, we're still busy. Hurrah, hurrah. And I was going, yeah, okay. 6 months later, they were struggling for any work. They had too many people. We had thinned our business down, and we kept the people we wanted to keep, right? Because actually, that was my early warning sign. That was my direction of travel. Right? For me, businesses that run themselves from cash are driving their car in the rear view mirror. Where have I been? Where have I been? Where have I been? Businesses, for me, who understand it by work taken on are looking forwards. They're looking forwards at understanding their working capital cycle. They're understanding what's going to happen within their business. That's what your management information should be doing for you. It's doing if you're inside the business, it's doing all the things you've talked about, understanding your WIP, having your billings, performance of people going on. But actually, for me, managing my business, it's the aggregation of all that information to a management team which gives us information about knowing where we're going, not where we've been. That's what a management information should do. And if you're using it in that way, that's really powerful to you. What the hell lets you do is this, cash flow. Hurrah, let's have a cash flow forecast. Now, typically, most of my firms' cash flow forecasts look like this. They divide their revenue by 12 and have a flat line, hurrah. And then there's a bit of working capital across the bottom, VAT returns and tax and rents and stuff like that. That is so often the professional services firm cash flow forecast. And I get scared when I see one of them. The reason I tend to get scared is because actually it really looks like this. Oh, what happened? Well, you go mad at something called a year end. Why do you have a year end? Why do you go mad at your year end? Well, it's bonus time, Steve. You know, we've all got to perform. You know, we always have a great year end is the fun. It's all about that seasonality. We always have a great year end. To which I go, oh my goodness. We used to have it. So understand, I walked into an accountancy firm where being accountants, they were really, really good. 5th of April was the year end. So they worked out if they billed everything in the 1st to the 4th of April, they saved another quarter's VAT. Hurrah! That looked like berserk. I walked in and we were doing like 50% of our turnover in the last month. And I'm supposed to manage this. It took me a little while to calm that down. But every time you calm down a year end, you have a problem. Because you haven't got the income. Bonuses don't get paid. Right? So this is the conundrum you get. You go mad, which is great for cash a month after. Then you end up the first quarter. How can you bill well in the first quarter when you've nicked it all in the year before? Right? So the first quarter is always a struggle. It's normally April's your year end for so many people, because your accountants tell you May, June, July's a struggle. Then you drift into August, September, about now. So we suddenly get, oh my God, it's almost October, almost 6 months. Quick, run around, because the first time we're going to be tested by our bank for any covenants they might give you is October, because you've sort of explained to them it's a bit early to tell you what's going on here. So then you get to October and you have a rush. Then we head to Christmas, the disaster that is Christmas, always is every year. And then you're getting ready for the next year end. Aha, there are 2 year ends here, so let's understand, clever ones have spotted, right? So that cycle pumps its way through your practice if you allow the year end to dominate you. And it does 2 things. It gives you a cash requirement about now, and there's tax to be paid and all the other bits, and you're heading into the summer, and a huge requirement come January every year. One year when I was managing partner, it come to September, we're doing the minutes, we're running the meeting. Oddly, it tells you how bad my partners are, because it was only halfway through the meeting did I realise we actually were using last year's minutes. Because we have the same conversation every year about the same issues every year. It's really boring. You know, around here we're talking about the problem with cash in January. Right? But that's my question to you is, if your management information is coming together and giving you information, it's allowing you to look forwards, managing your cash, not looking backwards as you've managed it. Final bit, got some thinking for you, for those of you outside the box, to help you understand professional service firms' life cycles. This comes from Laura Empson, who works at, I lecture at Katchr Business School on their master's course on charity management, the sector that I do a lot. And Laura did this, which was the growth cycle pathway and stress points of professional service firms. So we start young, entrepreneurial. Our stress point is succession. Who's going to come and join us as a 2 or 3 partner firm? We either continue to grow, we become the classic 5 to 10 partner size firm, we become a disorganized rabble. Right, we meet every so often, but we don't do what we are. How are we controlling a disorganized firm? Really difficult for investment decisions at this point in time, particularly if your disorganized rabble is male, pale, and frail. Right? Why are they investing in something for technology for the future when they want to retire in the very near future? Real challenge. Then you form committees. If you get big enough in your organization, you'll form committees. By the way, first message is, the first committee you'll form is the remuneration committee. Because after there's about a dozen of you, you can't make it mind who gets what. Be on the remuneration committee. Right? First lesson of life, be on that committee. Right? But actually the committees then become the way in which you run your business as it gets bigger. IT will be next, marketing, hugely frustrating place to be. Decision making becomes really challenging, because my lawyers would love every opportunity not to make a decision, so the committees don't have the benefit of it. Then we moved into a managed arena. We're now big enough to have a proper management structure, which means we become disconnected. Fascinating, that's a great place for opportunity. All of these are cross-selling. You talked about one of the other things, you know, how you grab the opportunities and cross-sell them is available to you at every level. The disconnected society, you either grow up and through it and become corporate, or you go off and federated or merger model. That's where GTs, Grant Thornton and BDO started. Right? They started as federated groups, 5 to 10 million turnover size. Is that a direction of travel for your sector? Quite possibly. As people align themselves more closely, share internet, share intelligence, do things together. Right? And oddly, along this way, as you grow, at every stage of growing, some people don't fit. They should be sole practitioners, and they found themselves in the places they shouldn't be. So you see that constant dispersal down. It's one of the reasons we've got 10,000 law firms in the UK, and we've still got 10,000. We've still got a load of small sole practitioners doing their own thing, some of whom have grown up and fallen away. But the opportunity for that path is there. And finally, I want to share a picture with you, and the first speaker talked about the decline curve. This is my decline curve. This is my decline curve for legal services that get into trouble. Why? First, politics. If the politics goes wrong, what you have is a lack of coherent strategy. And if you're trying to talk about investment in technology and everything else, if you haven't got that, you've got a problem. And as you decline, what that leads to is clients and consumers get lost in the process. The business declines, lock-up can stretch. You start doing things you shouldn't do. MI should now be picking up your problems. Is it? Question. Then risk and regulation. Now you've passed, you're dropping down. Things start to go wrong. Controls go wrong. You get more claims. You get issues that go with that. You pass the control watershed. Anywhere above here, you can do your resurrection, turn around, grab the business and back up the other side. Lose control. Control goes for 2 reasons, regulatory risks or financial risks. Businesses do not fail. Well, wrong. Professional services fail when they run out of cash. right? Not a balance sheet or the assets that they've got. When they run out of cash, you fail. But actually, your cause of your failure is not the fact you run out of cash. It's something that's gone on systemically before then. And that leads to the cash crisis. So your job for management information is avoiding all of that. It's spotting it, it's using it, it's giving you that view forwards, about directing the business. And for those of you who are the accountants, that's your challenge with to your lawyers. For the lawyers, it's your challenge of understanding and challenging. Final message for me, challenge nicely. If you're a lawyer and you don't understand, ask. Ask your partners if they do understand, and if they don't, help them to understand. If the accountants, what you can't do is, and I'm non-exec on a couple of law firms, so I have this challenge where I have the accountant this side and the lawyers this side. Right, and there's that famous quote, you know, what's the difference between a POM and a jumbo jet when they land in Australia? The jumbo jet stops whining first, right? Because they don't, so what you get is, they think all the accountant is there for is to whine and moan. Have you done your timesheets? Have you done your billings? Have you changed your cash? Have you done your timesheets? Have you And eventually they tune off, stop moaning at me, and then then the important message is missed. Challenge, communicate, challenge. And for you in IT and sales and marketing, absolutely understand why this is critical to your business's success.